If you think the energy transition is just about building solar panels and wind again, the real battle now is who can buy that clean power, lock it in for the long term. Corporate Power Purchase Agreements, or CPPAs, are becoming the single most important tool for tech giants, manufacturers, and data center operators to secure cheaper, greener electricity across Asia Pacific. In 2025, Meta, Amazon, Google, and Microsoft alone signed 49% of all global clean energy deals, about 55.9 gigawatts worth. And the story in Asia is just getting started. In this video, we'll break down why TPAs in Asia are booming, which countries are leading, which are falling behind, and how data centers. Trade regulations are completely reshaping how companies buy power in this region. Before we go deep, let's make sure everyone's on the same page. A corporate PPA is a long-term contract, typically 10 to 25 years, where a company agrees to buy electricity directly from a renewable energy project at a fixed or index price. For the buyer, it locks in cheaper, predictable power costs and helps meet decarbonization goals. For the developer, it provides a guaranteed revenue stream that makes the project bankable. Banks and West investors love that certainty. There are several types. On-site PPAs, where you install solar on your rooftop. Off-site physical PPAs, where the power comes from a remote project through the grid. And virtual PPAs, which are essentially financial hedges. You don't take the electrons, but you take the economic exposure. The reason this matters for Asia is that, in many countries, the grid is controlled by state monopolies. So which type of PPA is even allowed varies hugely from market to market. Let's zoom out first. In 2025, global corporate clean PPA volumes hit 55.9 gigawatts, down 10%, from 2024's record, marking the first annual decline in nearly a decade. But here is the twist. It was still the second highest year ever, and the decline was almost entirely driven by smaller companies pulling back. The number of unique buyers in the US fell by half, from 68 to just 33. While Meta and Amazon together contracted over 20 gigawatts of clean power. So the market is splitting into two speeds. Hyperscalers, who are scaling up aggressively because they need the power for AI and data centers, and everyone else who is hitting pause because of policy uncertainty, tariff risks, and rising costs. This two-speed dynamic is playing out even more dramatically in Asia. In Asia Pacifically, corporate PPA volumes dropped to 6.9 2025, down from 10.7 GW in 2024. That sounds alarming, but context matters. The 2024 number was inflated by megadeals, like UIO's more than 2 gigawatt procurement across two PPAs. Strip out those one-off deals, and the underlying trend is still positive. Bloomberg says the outlook for APAC remains positive, pointing to new PPA frameworks opening in Malaysia, a maturing Japanese market, strong demand in Australia, and likely underreported volumes in India. Amazon was the single most active corporate buyer in Asia Pacific in 2025. The key insight: APAC's PPA market is increasingly bifurcating between countries like Japan, where adoption is getting more sophisticated, and countries like Malaysia, where growth depends on government programs. One of the best indicators of corporate appetite is the RAA Leaning initiative, over sushi companies, globally committed to sourcing by renewable electricity. Here is the striking number: 500 of all new RO Leaning members since launching in are headquartered in Asia and Pacific. And so of the largest new joiners are Asian companies. Roughly 500 of the new electricity demand from recent RO Latin members comes from Asia. But here's the problem. RO Leaning members consistently rank Asian markets, South Korea, Japan, and China, among the most difficult places globally to actually procure renewables. So you have this enormous gap between corporate demand for clean power and the ability to actually buy it. That gap is exactly what drives the urgency around PPA policy reform across the region. Let's start the country deep dives with China, because what is happening there is unlike anything else in Asia. In May 2025, the NDRC and NEA issued a landmark policy, formally permitting green power direct connection. a model where renewable generators bypass the national grid and supply industrial users directly via dedicated lines. By early 2026, at least 12 provinces had issued implementation policies, and 5 provinces announced pilot projects, totaling over 7 gigawatts. This isn't a traditional PPA market. It is a uniquely Chinese mechanism, but the economics are real. The cost advantage of green power direct connections in China is becoming hard to ignore. A subsidiary of China Baowu Steel Group saved nearly 4 million yuan on 60 million kilowatt-hours of green electricity between March and December 2025, cutting power costs by 8 to 10%. CATL, the world's largest battery maker, is building a 40 gigawatt-hour lithium battery factory that will be powered entirely by self-generated renewable electricity, expected to be operational by 26 and 2027. Sinopec's green project in Trunechu, Spain, has been direct. Isol say, DUXCT Sol. Wood Mackenzie calculates that wind and battery hybrid systems in China now deliver power at roughly one-third of the local utility tariff. And on the multinational side, BASF signed China's first-ever foreign company, long-term renewable PPA in 2022, a 25-year deal. Driven partly by the EU's carbon border adjustment mechanism, China is expected to roll out full-scale green power direct connections nationally in 2026. Japan is arguably the most impressive corporate PPA growth story in Asia. The first corporate PPA in Japan was signed in 2021. By mid-2025, there were over 500 disclosed deals, representing more than 2.5 gigawatts of installed and planned capacity. Japan posted a record 1.1 gigawatt of corporate PPA activity in 2025 alone, making it APAC's standout market while everyone else slowed down. What is driving this? Japan is transitioning from the old government feed-in tariff system to market-driven, non-fit models. Companies and developers are signing private contracts for renewable power that operate entirely outside the subsidy system. A landmark example, in February 2026, Nomura Real Estate signed a PPA with Clean Energy Connect for solar plants under a fully non-fit structure, securing long-term price certainty through private contracts rather than government tariffs. What makes Japan's PPA story even more significant is who is signing these deals now. Data center operators. In April 2025, Equinix signed a 20-year, 30-megawatt solar PPA with Trina Solar for the Ufutsu Obara project. In Hokkaido, this is a game-changer. Data center operators are no longer just buying certificates or green tariffs. They're directly financing greenfield renewable projects through long-term power contracts. Both physical and virtual PPAs are in use. Virtual PPAs are gaining ground because they're more flexible. Corporates don't need to change their electricity retailer or deal with complex wheeling arrangements. In a post-Fukushima context where Japan has struggled to balance energy security with decarbonization, corporate PPAs are providing a market-based mechanism to finance new renewable capacity outside traditional government schemes, with data centers single-handedly reversing Japan's decade-long decline in electricity demand. Expect this trend to accelerate dramatically. No, let's move to Southeast Asia. And this is where the story gets complicated. The fundamental challenge is this. Only Singapore and the Philippines have fully liberalized power markets that allow businesses to procure green energy independently. Everywhere else, Malaysia, Thailand, Vietnam, Indonesia, state node, utilities control both the grid and powers. That monopoly structure makes it impossible for companies to sign direct PPAs. The reluctance of state utilities to embrace PPAs stems largely from financial concerns. High-consumption industrial customers represent their biggest revenue streams, and a shift toward corporate PPAs could disrupt their business models. But the pressure is building from both sides. Multinationals need clean power for their supply chains, and governments need private investment to meet their bureaucracies. Despite the monopoly barriers, there are real openings emerging across Southeast Asia. Thailand has introduced a framework for direct renewable PPAs with a pilot allocation of 2,000 megawatts. Malaysia's corporate green power program for virtual PPAs was fully subscribed, showing that demand far outstrips what the current regulatory framework can absorb. A 21-year solar PPA in Malaysia is delivering approximately 1 terawatt-hour proof. that long tenure deals are possible even in partially regulated markets. Malaysia also launched the CRESS scheme specifically targeting data center sustainability. Vietnam activated its direct power purchase agreement framework under the revised electricity law, allowing large consumers, factories, data centers to contract renewable power directly from generators. Fitch BMI cautions that corporate PPAs will play a limited role in overall renewable growth due to regulatory roadblocks. But the same analysis acknowledges that Vietnam and Malaysia offer real optimism. These are early moves, but they signal the direction of travel. Two other major markets deserve attention: South Korea and India. South Korea was ranked by ROALININM Embers as the single most challenging market globally for renewable energy procurement. The CADES-in ROALININ framework provides multiple pathways: green premiums, renewable energy certificates, and PPAs. But limited renewable supply and policy have kept volumes. The good news: South Korea's 2026 Energy Transition Plan and the new Offshore Wind Special Act should gradually expand the renewable pool available for corporate contracts. In India, PPA volumes declined in 2025, but Bloomberg NEF says actual corporate PPA volumes may be significantly higher than publicly disclosed data suggests. India's massive auction pipeline, over 63 gigawatts recently, half in hybrid solar wind storage format, creates a rapidly expanding pool of projects that lend themselves to corporate offtakes structures. Both markets have enormous latent demand. The question is how fast regulation and grid infrastructure can catch up. No. Let's talk about the force that is fundamentally reshaping the corporate PPA landscape: data centers. Pacific capacity is projected to grow from 12.2 watts in 2024 to 26.1 ITS by 26. Regional data center electricity consumption is expected to rise from about 320 terawatt-hours in 2024 to 780 terawatt-hours by 2030. In Southeast Asia alone, data center power demand is forecast to quadruple, from 2.6 gigawatts today to 10.7 gigawatts by 2035, potentially driving 7 to 10% of all regional power demand growth. Malaysia and Thailand are emerging as the largest data center markets in the region, with on-grid electricity spending potentially quadrupling to $10 billion by 2035. This isn't gradual growth. It is a structural demand shock. Here is the crucial insight for investors and operators: have Shakti from NDIDAZ preference to a competitive. The structural gap is clear. Renewable generation in Asia is expanding at roughly 13% annually, but data center load is growing faster. The gap is structural, not cyclical. In Tier the 1st of March KETS, Singapore, Tokyo, Seoul, Sydney, Mumbai clean power contracts, not capital, are becoming the gating asset. Operators with early access to renewable supply gain financing advantages and tenant preferences. Recent platform deals have been priced above 20 times forward earnings, showing that capital markets are pricing energy certainty into data center valuations. Leading operators are responding by securing long tenure contracts of 15 to 21 years that finance new renewable generation, diversifying procurement across physical PPAs, virtual PPAs, green tariffs, and certificate-based structures, co-investing in renewable projects, and investing in behind-the-meter solutions like battery storage, hybrid microgrids, and dedicated substations. Energy procurement is shifting from operational cost management to strategic asset design. There is another powerful force accelerating corporate PPA adoption in Asia that many people are underestimating: the EU's Carbon Border Adjustment Mechanism, or CBA. CBAM entered its definitive phase on the 1st of January 2026. It links the embedded emissions of imported goods directly to the energy used in production. For ASEAN manufacturers exporting to Europe, this transforms energy procurement from an operational concern into a market access determinant. Carbon prices across Southeast Asia are substantially lower than those under the EU emissions trading system, meaning exporters who can't demonstrate low-carbon production face significant costs. Penalties at the European border. Bloomberg NEF notes that as the EU's third-largest trading partner, ASEAN cannot avoid CBAM's impact. The mechanism is expected to accelerate corporate renewable procurement across the region. We already saw this at work when BASF signed China's first foreign company PPA, partly in response to CBAM-style pressures from European headquarters. For factories across Vietnam, Thailand, Malaysia, and Indonesia that export to Europe, securing a renewable PPA is no longer just about sustainability. It is about staying competitive. Let's talk numbers because the economics are increasingly the strongest argument for corporate PPAs in Asia. In China, utility-scale solar now comes in at around $27 per megawatt. Our onshore wind in China, India, and Vietnam ranges from $25 to $70. Wind and battery hybrid systems in China can deliver power at approximately one-third of the utility tariff. In Japan and Taiwan, corporate renewable PPAs are roughly 30% cheaper than grid electricity. 4-hour battery storage is expected to fall below $100 per megawatt hour by 2026, and costs are projected to drop another 35% through the 2030s. In China specifically, battery system costs are heading toward $84 per kilowatt hour by 2034. India has the strongest cost reduction potential at nearly minus 40%. Wood Mackenzie projects that total Asia-Pacific energy storage investments will exceed $500 billion over the next decade, fundamentally reshaping how PPAs can be structured. This cost trajectory is what is enabling the shift from simple solar-only PPAs to hybrid baseload, like products that deliver round-the-clock clean power, exactly what data centers need. There is a technical but hugely important shift coming that will reshape the corporate PPA market. Changes to Scope 2 carbon accounting. The Greenhouse Gas Protocol is updating its Scope 2 guidance, and proposed revisions could require hourly emissions tracking and tighter geographical matching for indirect electricity purchases. Under the current rules, a company can buy a solar PPA that generates power during the day and claim it covers their electricity use at night. The new rules would say, no, you need to match hour by hour. This makes 100% renewable energy claims much harder to substantiate with simple annual matching. And it is driving a structural shift toward more complex deal structures. Bloomberg NEF tracked 5.8 gigawatts of co-located and hybrid agreements in 2025. Solar paired with storage or solar combined with wind, specifically designed to deliver around-the-clock clean power. 7 of the top 10 global PPA sellers are now offering firm, dispatchable clean power solutions, rather than standalone solar or wind contracts. For Asia, where many markets are just beginning their PPA journey, this means the bar is being raised before they've even caught up. The corporate PPA market in Asia is rapidly moving beyond simple, I buy your solar output contracts. In China, the Green Power Direct Connection model is creating a new category: dedicated lines from renewable projects to single industrial users, bypassing the grid entirely. In Japan, the shift from physical to virtual PPAs is accelerating, giving corporates more flexibility without needing to change retailers or navigate wheeling. In Malaysia, long tenure deals of 21 years delivering nearly 1 PPA show that even partially regulated markets can support sophisticated structures. Globally, baseload-like products, solar plus storage, hybrid solar and wind, or nuclear PPAs, accounted for 5.2 gigawatts of activity in 2025. Data center operators are going even further, taking minority stakes in renewable projects, building behind the meter microgrids, and exploring small modular nuclear reactors for long-term baseload demand. The Bloomberg NEF analyst put it well, we're seeing a transition from standalone products to more hybridized products or structured solutions. The era of simple, single-technology PPAs is ending. The future belongs to portfolio-based energy procurement strategies. Let's do a rapid-fire outlook for each major market through 2030. China, strong growth. Full-scale green power direct connection rollout in 2026. Plus CBAM exposed exporters driving demand. Wind battery hybrids at one-third of utility tariffs make this unstoppable. Japan, continued record growth. Over 500 deals already signed. Data center PPAs accelerating. Floating offshore wind creating new supply. The non-FIT transition is the key catalyst. India, recovery expected, massive auction pipeline, underreported volumes in TY2 opportune, 500 gigabos of recent to deeped osai currents of torti emative abats uik batunis or 2. Steady. The most mature PPA market in APS supported by the Cassidy investment Strong mening and Dudu Strisseldement. Malaysia, fast-growing from a low base driven by data center demand and the CGPP and CREST programs. Thailand and Vietnam emerging. Both have pilot frameworks but need deeper regulatory reform to unlock scale. South Korea, slow but improving with CADES and RO leaning reform, and the Offshore Wind Special Act. Singapore, constrained domestically, but positioning itself as a regional PPA hub with 6 gigawatts of clean power imports targeted by 2035. Let me bring this all together. The corporate PPA market in Asia-Pacific is at a genuine inflection point. The 2025 volume decline masked a structural acceleration driven by 3 megaforces: data center demand, CBM, and trade, regulation, and improving renewable cost economics. Bifurcating on one side sophisticating PPA CACCA. Et chet zize pan, 1-2, U40, a steve chunai, a joan U-la-4, guadi, wola-stu-si, dissocied, sauti de Latin for 2026 to 2030 is whether Southeast Asian governments can liberalize electricity markets. And wide access fast enough to absorb access fast enough to of corporate demand deriving hyperscalers, CB BAMs and exposed manufacturers and ROO members. For data center operators specifically, clean power procurement has moved from a sustainability add-on to a core competitive capability. It is the new moat. The operators who secure credible, deliverable clean megawatt hours at scale will win. Those who can't will be left behind. This story is just beginning in Asia, and we'll be tracking every development on this channel. If you found this useful, hit subscribe, and I'll see you in the next series. 1.